Pepsico stock, ticker symbol PAP. This stock is down almost 9% year to date. And although that seems like a lot, it's better than most companies did this year. The S&P 500 is down 21% year to date, so that's quite interesting. Do investors see Pepsico as a defensive dividend stock? Well, to be honest, the dividends are looking really good. Almost 3% dividend yield and a dividend growth of 50 years in a row. But more on that later in this video. First, I'm going to check what Pepsico does, a quick view at the historical stock price performance, the fundamental analysis, the dividends, and of course their major competitors. I'm very excited to see what you guys think about this stock, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. Please subscribe to join the community and to receive multiple analysis every week, where I will tell you everything you need to know about the stock market. So, what does PepsiCo do? PepsiCo is one of the largest food and beverage companies globally. It makes, markets and sells a slew of brands across the beverage and snack categories, including Pepsi, Mountain Dew, Gatorade, Doritos, Lay's and Ruffles. When we check the net revenue breakdown and operating profit breakdown, we see that they have 7 segments, where they only break down North America into 3 segments: Frito-Lay, Quaker and Beverage. All combined, North America represents 65% of the total revenue. Second largest is Europe with 11%. The revenue growth year over year is at 9.3%, and the largest segment, PepsiCo Beverage North America, is growing at 5.4%, which is below the growth of the average of PepsiCo. But the second largest segment, which is Frito-Lay North America, is growing at 14%, which is above the 9% average. All other segments are growing as well. When we check the overall breakdown by food and beverage, we see that a shift has been made. Back in the days, beverage was at 52%, and in the past couple of years, food became bigger and bigger. One of the things I want to highlight is that more and more people are trying to eat healthy. At least, that is what we think and assume. It's expected that the beverage industry is still growing at a compound annual growth rate of 1.7% in the coming years, which isn't a lot to be honest. So, with PepsiCo being one of the bigger companies in the beverage industry already, there's not a lot of growth organically. So, now that we know more about the company and the industry, it's time to check the historical stock price to see what happened in the past couple of years with this stock. I decided to include the S&P 500, Coca-Cola, Keurig Dr Pepper and Monster Beverage. So, on the 5-year chart we see that the PepsiCo had a 55% return including dividends, while the S&P 500 had a 70% return. So you were better off owning the S&P 500 in the past 5 years. Coca-Cola had a 54% return, KDP a 156% return and Monster a 73% return. So only PepsiCo and Coca-Cola had a lower return than the S&P 500. On the 1-year chart it's exactly the opposite. PepsiCo and Coca-Cola had the highest return while the S&P 500 had a negative 9.4 return. On the 6-month chart we see that PepsiCo has a minus 7% return, while the S&P had a minus of 90% return. Coca-Cola is the only one with a positive return. On the 1-month chart all stocks are down, but only Monster did a better job than the S&P 500. And with that being said, it's time to check the fundamentals of PepsiCo to see if they are a buy or not. PepsiCo is a 218 billion market cap company with a PE ratio of 21. A forward PE ratio of 23, which is normally around the fair value for a company. But to be honest, a company this big and with an industry growing at only 1% per year in the coming years, I think this current PE ratio is too high. Next up are the margins. Operating margin is sitting at almost 15% and profit margin is sitting at 12.5%, which is above the 10% minimum, so that looks really good to me. When checking the margins over a longer period of time, we see that they go up and down a lot. So you want to keep an eye on the margins. They should stay above the 10% minimum. Return on asset is at 6.9%, which is too low. You want this number above 10%. Return on equity is at 62%, which is fine by me. Return on invested capital is sitting at 11%. So that's right above the 10% minimum. But the 5-year return on invested capital is sitting at 9.4%, so you want to keep an eye on that number. The 12th trailing month revenue is sitting at 80 billion, and the quarterly revenue growth year over year is at 9.3%. Both look good to me. When checking the revenue over the past years, we see that it hasn't been really great between 2012 and 2019. In this period, revenue decreased a little bit, but since mid-2019 the revenue went up again. Next up is the balance sheet. Pepsico has almost 7 billion in cash and 40 billion in debt, so this doesn't look good, especially for a company this big. They are not capable of paying down a big chunk of their total debt. But how about the free cash flow growth? For me, it's very important that this is growing, since this is used to pay down debt, of course, but also to buy back shares, pay dividends, do acquisitions and research and development. In this graph we see that it's not going up nice and steady, so that's also something I don't like. A thing that I do like about Pepsico are the shares outstanding. In this graph we see that they bought back a lot of shares back in the days, but lately they haven't been buying so much. The 5-year average is at 3%, which isn't that high, but at least they are buying back shares. This increases the EPS, which attracts other investors. And of course, it's more easier to maintain and grow the dividends. And since we're talking about dividends anyway, let's check the dividend scorecard. The current dividend yield is at 2.92%, which is above the average in general. Annual payout at $4.6 a share, payout ratio at almost 68%, which is quite high. They only have 32% left in cash to pay down this huge debt, buy back shares and do acquisitions. So to be honest, this doesn't look really good. You want the payout ratio to be below 50%. The 5-year growth rate is 7%, which isn't too high either. But since the payout ratio is already this high, I don't think it's healthy to have a higher growth rate. But I think that is impressive is the dividend growth. 50 years in a row. Very nice. The last thing that I want to show are the fundamentals versus the major competitors. Again, I included Coca-Cola, Keurig Dr. Pepper and Monster Beverage. When we check the valuation, we see that all stocks are trading between 20 and 25 PE ratio, except for Monster Beverage. This seems not too high, but keep in mind that the industry grows at an average of 1% each year, so there's not much growth. In this graph we see that Monster has the highest 5-year revenue compound annual growth rate. Coca-Cola has the negative growth and PepsiCo only 5%. Net income compound annual growth rate is a negative at PepsiCo. And KDP is definitely the winner here. Leverage free cash flow compound annual growth rate doesn't look really good either. But that's something we couldn't expect with a low net income growth. Monster has a negative free cash flow growth, which is also quite interesting. Coca-Cola has the highest margins, which is quite a difference with PepsiCo. Return on equity is the highest at PepsiCo. Return on assets is the highest at Monster, and return on total capital is also the highest at Monster. When we check the dividends, we see that PepsiCo and Coca-Cola pay almost the same amount of dividends in terms of dividend yield. KDP is significantly lower at 2.15%. The payout ratio is also very similar at PepsiCo and Coca-Cola, but KDP has a significantly lower payout ratio. The 5-year compound annual growth rate is the highest at PepsiCo. The consecutive years of dividend growth is the highest at Coca-Cola with 59 years in a row, but PepsiCo is right behind them with 50 years. KDP is sitting at only 1 year. So my final conclusion is that companies like PepsiCo are always nice to have when it comes to a defensive dividend play. This stock will pay you a steady dividend, but that's all. There's not much growth at only 1% per year in this industry, and PepsiCo only grows at a 5% each year, which is also quite logical since they are one of the largest food and beverage company already. So I don't think PepsiCo is a buy right now. Debt is too high, free cash flow isn't growing at a steady pace, and payout ratio is also too high in my opinion. I think whenever PepsiCo hits a PE ratio of 15, I'm going to do a new analysis. So that's it. I'm going to skip this stock for now. But remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching, and I will see you in my next video.